then the higher the reward. So if you are investing, just see risk as an opportunity for you to gain higher reward for taking a particular decision or buying an investment product. Okay, so don't see risk as a chance of losing money. That is not right, but rather see risk as a possible or like a possibility for you to gain reward. Okay, so risk is about uncertainty when it comes to outcomes. That one is very true because when you take risk, most of the times you don't know whether you gain a positive result or are going to gain a negative result. Okay, and as I said earlier, risk is not always bad. In fact, for the long-term investors, they appreciate risk because it gives them the opportunity. It gives them the opportunity to rise to gain higher potential returns. And if you know the saying that by the one of the greatest investor in this world, that is Warren Buffett, he said that you have to be greedy when people are afraid. When people are afraid to take risk, that is when you have to go in for all. And then he said that you have to be afraid when people are greedy. So you see how it goes. When people are afraid to take a risk, then that is a great opportunity for you as an investor. So don't always see the negative aspect of risk, but the positive. Try to also see risk as an opportunity for you to gain money. Just that you have to be really careful when it comes to risk. Don't just rush to take any kind of risk. Take calculated risk. Okay. So for low, we have low risk investment. Okay, so those ones are have predictable returns. It has low growth, and that one is good for short term money or safety buffer. So we have low risk investment like that you're going to lose your money. That the interest return is very low, sometimes 10%, 13% on your money. Okay, and then we have the high risk investment. That one is unpredictable. It has a very high potential growth. You can earn a lot of returns. Okay, but it is good for long-term money, which you do not for now. Okay, so example of the high risk investment are the stocks. Okay, and we know how the stock has been very volatile. Today the price is 7 cedis, tomorrow is 2 cedis and all that. So if you are going in for the long term, then you are supposed to go in for the high risk investment instead of the low risk investment. Okay. So now let's talk about volatility. Okay. So when we talk about volatility in investment, I believe on today on this page, that is what I shared, normally every day we share insights on the page. So for today, we talk about volatility. And for those of us who read it, at least we had an idea about it. Okay. So let me use this scenario to explain what volatility normally is. Okay. So let's say you invested 1,000 cedis in a particular investment vehicle. And then by the end of or in the first 6 months, your investment has dropped by 30%. So if you invested, let's say 1,000 cedis, that means in 6 months' time, your investment value of portfolio has reduced to 700 cedis. And then maybe in the next 8 or let's say in the next 2 years, it rises by 50% again, and then it drops 10% in the third year, and then it rises like 60% in the fourth year. You see the rise and drop of your portfolio value is what we call volatility in investment. Okay, so volatility, if you look at this subsection, it says that time smooths volatility, and it is very true. And that is why it's always good for you to go long term in your investment. Because if you go in for short term, maybe someone told you that for the stock market, if you buy MTN shares and it rises, gain capital gain, so rush and go and buy it. Okay, so what if you are going for the short term and then you invested, let's say, 1,000 cedis in MTN, then the next day you woke up and then the price has reduced by 40%? What are you going to do? Because you've already set your mind that you are going for short term, it's going to affect you more. But then if you are a long, you understand that, oh, if the price falls or drops by 80%, I know that I'm in for long term, 5, 7, 10 years. So within the years, definitely the price will start rising again. So there's nothing to even fear. So when a particular price of a stock falls and people are panicking, some people are rushing to ensure that they sell all their stocks so that they don't make losses. You know that this is an opportunity to even buy more stocks because I'm in for the future, I'm in for the long term. So I know in the next 7 years, I'm going to benefit more. And that's why Warren Buffett said that be greedy when people are afraid. Okay, when people are afraid to take risks, that is when you have to be greedy and buy more of that particular stock. So understand that time is your buffer against volatility. Okay, if you really want to avoid volatility when it comes to investment, then you have to be a long-term investor. Okay, so now let's talk about the power of compounding. We all understand what compounding is, but in case maybe we want further elaboration, then compounding is growth on top of growth. Okay, so you earn returns and then your returns also earn returns, and that returns also earn returns. So let me use this simple scenario to explain it to us what compounding really means. Okay, so it's more like when two people, a man and a woman, decided that let's fall in love, get married. And then for the next 10 years, they've given birth to like 5 children. And then the children to grow up in the next 20, 25 years. And they will also give birth to grandchildren. Then the grandchildren to grow up, they'll get married, and then like they'll keep on producing and producing. So within 100 years, you'd be like just two people who decided to get married are able to create of over 100 people, and that is how compounding really is. Okay, so this is an example. If you invest 500 cedis monthly for the next 30 years at 10% annual return, then that means in 10 years you would have invested 60,000 cedis. But then because of the power of compounding, your account will be worth approximately around 102,000 cedis. So just imagine you are getting close to 2 times the amount that you invested in. Now, CO, the same amount in 20 years, that means you would have invested 120,000 cedis, but you'll be getting 382,000 cedis. And that is 2 times the amount you have invested in. And that is how compounding works. Now, if you decided to spend 30 years, and that means that you have invested 180,000 cedis. Please, let's take our time to digest this. You've tried to invest 108,000 cedis in 30 years. Now, because of the power of compounding, by the end of that 30 years, you'll be having 1,130,000 cedis. And that is almost like 10 times the amount that you've invested in. And that is how compounding works in. Now, some of us will be thinking like, hey, let's say 10 years there is far or it's long, 20 years, 30 years. Now ask yourself your current age. Even let's say that we are all 30 years of age and you decide to start investing for the next 30 years, that means you'll be right for your pension. That means that once you hit 60, you'll be having over 130,000, over 1,130,000 cedis in your account. And mind you, some of the investment, it has over 20% annual return. Okay, it has some of the stocks, it has like over 30%, some is even as high as 30%. So if your investment has as the return is as high as 30%, that means that by the end of year 3 you'll be have like 5 million or almost like 10 million cedis, even though you just invested 180,000 cedis. And so that is how compounding really works. Okay, so you also have to understand this, that when it's come to compounding, it normally rewards patience. It's not about timing, but it's about patience. The first few years might be slow, but then if you've already psyched your mind that, oh, I am investing for the future, I am investing so that compounding can really work for my money, then you know that the first 2, 3 years are going to be slow, but then in the next 5, 7, 10 upwards years, then compounding will start working for you, and then your money is going to multiply and grow exponentially for you. Okay, so you also have to understand that consistency really matters. If you decide to invest 1,000 cedis a year, you won't be investing, but at the end of the year, you just invest 1,000 cedis. It's good. But then for someone investing like 100 cedis monthly, that person consistently every month, the person is investing 1,000 cedis, 100 cedis. That person will beat the one who is investing 1,000 cedis a year, just because the person is consistent with the amount that he's saving. Okay, so when it comes to investment, understand that what really matters is patience and your ability to be consistent in investing. Okay, now let's talk about why patience is difficult when it comes to investment. It's very, very difficult. I mean, just imagine you have to be investing maybe 100 cities, 200 cities, 500 cities continuously for 10, 20 years. It's difficult. Life is full of like uncertainty. Things can happen that will push you to maybe go in for your money. And that is why patience is really difficult when it comes to investment. Okay, but then you also have to understand that people who really benefit from investment are not the smart individuals. They are not the ones who know how the market works and all that. No, those who really benefit from investment are those who are really disciplined. To work for you for the long term and from it, then you have to be really patient, you have to be really disciplined and consistent as well. These skills will really push you when things are not really working, when your investments are crashing. You know that for the long term it's going to rise again. So I'll end by saying that investment is really difficult chance. But then you as an investor, you need to have the skills of patience, the skills of consistency, and then the skills of come to your investment. And that alone will help you to benefit from that. Before we start with our exercises for this week, I'll hand it over to Sebastian to ask questions, or if anyone has questions, the person can ask before I move on to the exercises for this week. Thank you.
Yeah, okay, so yeah, well, you can ask your question.
Okay. Yeah, Ahmed, thank you very much for this insightful presentation. Yeah, but I'm just doing some thinking to, from the example you gave, the 500 CDs the person invested, and he held it for such a long time. Is it does like is it a like a fixed f 1 minute soon. Is it fixed that definitely in the long term plan he's going to earn something, because some way somehow we can't predict what happens in the next 20 years. Is it possible that the company will run at a loss, that even the capital he used might end up in the drains or something? Like, is there any possibility like that?
Okay, so before Ahmed comes in, right? This is what you have to know. I don't think there is any investment that is risk free. That's why he's talking about risks as well. Okay. Now, in terms of the compound interest that we are discussing here, do you make returns, right? He mentioned that there are levels of what risk. So there is medium, there is low, there is high. Okay. Now, if there is a high risk, it means that your returns can or your gains can or is going to be what? Very high. If your gains will be very high, it also means that you have every possibility of also losing your money because it's what very high risk. Do you get it? So if you are going in for the low risk, your returns will be very low, and the possibility of you losing everything is also very low. Do you get it? So I think that's what I would talk about in that, and then leave the remaining for Ahmed to.
Okay.
Yeah,
Yeah,
all right.
so
So thank you.
okay.
Thank you, Sebastian, for answering the question. But I want to add in more to that as well. Yeah, what you said is really true that for investment, definitely there is associated with it, okay? But even the example that I gave about people investing 500 CDs consistently and then having 10% annual returns, yes, we have this investment vehicle, and that one is almost like risk free, and that is the government T-bills. That one, there's no way the government is going to default, even if like you bought it when MPP is in power and currently NDC is in power. It is mandatory of the government to pay you when the time is up. So that one, it is the only investment vehicle that has been identified as risk free, because no matter what, the government is always going to be there, unless maybe one day there's a coup and then like the government collapse or something like that. But we know that in a stable country like Ghana, there's no way it's going to be hard like that for something like that to happen. So for that one, if you are investing in T-bills, that one, I think currently the return is around 10 to 13%. So that one, it is fixed. There's no way you are going to lose your money. And so if you keep on investing in T-bills continually for the next 10, 15 years, then the compounding is definitely going to work for you. Because if you buy T-bill for, let's say, 128 days, or let's say 360 days, okay, at the end of the 360 days, you are supposed to be paid your principal, the amount that you used to invest. You're also supposed to receive your return. So it is up to you to decide that, okay, I want to reinvest the principal again plus the return that I earn, so that the principal will earn another interest for you, and then the return that you gain from the first investment from the T-bill will also work for you, and that is how the compounding will start working. So in the next 1 year again, you have your principal multiplied, your return also multiply, and then those ones will also start working for you, and that is how you will keep on working. But for some investments like, okay, so Yeboah, please come again.
Oh, please, can you can complete what you're saying before I ask my question?
Okay. So I was trying to also say that there are also some investments like the stock market. That one is very, very volatile. So that one, there's no one can tell you that, hey, invest, and then you keep on getting 10% returns or 15%. No, that one is very, very volatile. And that is why you need a professional broker or someone. As for me, because I learn on my own, I try to learn the investment. I have finance background, so I really understand how the stock market works. So I can manage my portfolio on my own. But for individuals who they can also like reach out to brokers, professionals who can manage your portfolio for you, so that you can gain consistent returns on your investments. All right, so Daniel, please, you can come again.
Okay. Thank you very much. Yeah. So is it advisable to like diversify your investment portfolio? Like maybe have have a percentage for short term and maybe a percentage for long term too. Do you subscribe to that idea?
Yeah, so when it comes to investment, diversification is one of the most important. I think it's mandatory. If you really want to grow your portfolio, then you should diversify your portfolio. You shouldn't only go for stock market, okay? Try to be like T-bill. That way you know that no matter what, you gain your return, and then you can also go in for. But it depends on what you want. If I'm going to invest and I'm looking for the future, maybe I want to invest for the next 10 years so that maybe I'll use it to get married. So that one, I know that this money, I'm not going to be touching it. So I can go in for the long term. But if I'm someone who knows that, hey, I am investing, but in terms of needs, I can count for that money, then I'll decide to also go in for short term, or maybe I'll combine both. I can go in for mutual fund. Even for mutual fund to it's difficult to like lose your money. That one, the returns is not really high, but then definitely you're also going to earn money. So diversification is, I won't say it's an option, It's mandatory for everyone to do it. If you really want to manage your portfolio, you should have mutual fund, stock markets, you should have T-bills and all that. Please, I hope I've answered your question.
Yes, please. Yes, please. Thank you very much. Yes, please.
All right, you're welcome.
Yeah. Okay. So, guys, do we have any other question? Any other question? Okay, so, I mean, I think we can continue.
All right, so let's look at the exercises for this session. And I believe this week's session, the exercises are really powerful. And I will urge everyone to do it, okay? And I believe some people send their workbooks to me, and I'm here to provide feedback on it. I'll definitely do it this week. Last week has been a bit let's say difficult for me, so but I'll definitely do that this week. So please make sure that last week's workbook, if you haven't submitted it, you do it as well, and then this week's own too, you do it, because this week is very, very powerful. Okay, so the this exercise 3 is to help you identify your risk tolerance assessment. This is very important. Okay, I'm saying it because we've heard news before. People invest, and when their investment crash, they collapse. Some people get heart attacks. Some people die just because their investments, as someone said in the comment section, scanache. So please, it's very important that you partake in this risk tolerance assessment so that you really understand your risk level. If you know that you are the kind of person, if you invest 100 cedis, let's say it falls down to 50 cedis, you start having like blood pressure, then you know that, okay, as for me, I'll just go for T-bills. Definitely, I'm going to make my money. If I don't even earn returns, no matter what, my principal, it's safe. But if you know you are the kind of person that you can lose 1,000 cedis and you can sleep without any concern, then maybe you can go in for the stock market, okay? So let's look at the work example here. How Amma assess her risk tolerance. Okay, so she's a 28-year-old with 6K in emergency savings. Remember, in week two, no, yes, in month two, we talk about having emergency buffer or savings. Okay, so for her, she has 6K in it, and after that, she decided to start saving 400 cedis monthly. Okay, so part A is time horizon assessment. How long are you investing for, and until which year will you start using the money? So she said that I have 32 years. This is long-term money. Okay, then the part B is on volatility. Look at how the question is being, the scenario is being set. It says that if you invest 10,000 cedis, 1 year later it is worth 7,000 cedis. That means 30% has dropped. How are you going to feel? This question, please, when you are working on this, try to reflect on your own. Imagine you've invested 10,000 cedis, then 1 year later, you are expecting your money to increase. Then when you check, it has reduced to 7K. How are you going to feel? As for her, she said that anxious, but then she will understand that this is normal and she will hold and keep on investing. Okay. She says she's not going to panic sell, but then she would definitely feel uncomfortable. Okay. So that is her, and you have to sit down, see how you are going to relate to that. And that's why I say this exercise is really, really important for everyone. Do it before you start investing. Some of us, I particularly, heard about investment. I started doing investment even before I understood all this. I didn't know my risk tolerance. Sometimes, if you are registering for an investment product, they'll ask all these questions. Now, I'll just take anything. Maybe I'll choose medium, sometimes high. I didn't understand until now. So it's very important for you to really understand your risk tolerance level before you do that. Okay, we have the part D is on the risk profile. Okay, so after completing it for the risk tolerance, Amma said that she's moderate to high. I can handle losses, but I understand that this is normal and she will hold and keep on investing. Okay, so I understand that's normal. I'll not sell based on fear. My 32-year timeline gives me confidence to hold through volatility. Okay, so now once you for, is it 1 to 3 years, 3 to 5 years, 5 to 10 years or more? Then the second one is I will not need this money until maybe 2050, 2030, 2040. For that. Okay, so the second one is the part B is on the volatility. How are you going to react when your investment drops and all that? At the time, risk tolerance level, and you will have to choose the one you stability and predictability. So that is why you can stick in for savings account, fixed deposit, low risk bonds. All these ones, it's almost certain that you will gain something, though the return is slow. Okay, but if your risk tolerance level is low to moderate, that means you can handle small fluctuation, but then you will still need stability, and that is why you can go in for mixing bonds and stocks. But your risk tolerance level is moderate, that means you can handle significant short-term drops if you believe in long-term growth. Okay, and if yours is moderate to high, that means you accept volatility as the price of growth, and so you can go in for stocks market and all that. So you will have to, at the end of this, you have to list your risk tolerance level, and then you state the kind of investment vehicle that you are supposed to focus on. So for exercise 4, it is focused on compounding visualization. Okay, so this table will help you to see how consistent monthly investment grows over time. So see, as for this one, there's assumption here that it is 10% annual return. There's no way your return is going to drop. The return is fixed, which is 10%. So if you're investing 100 cedis monthly, every month, you make sure that you invest 100 cedis. Then in 10 years' time, on normal circumstance, you're supposed to have like 12,000 cedis, but because of compounding, you'll be having 20,000 cedis. If you're investing for 20 years, you'll be having 76,000. If you're investing for 30 years, 226,000. Now compare the difference. You see that your money has been increasing exponentially, doubling, and that is the power of compounding. Okay, so when you are done, so you start doing the workings like personal compounding calculation. Okay, so you start asking yourself how much can you realistically invest monthly, then how long can you invest without touching the money. Okay, this is very very complex, but it's very simple as well, but you can make it complex if you really understand it. Let me give you an example. As for me, because I really have in-depth knowledge when it comes to investments like this, I have investments. My investment, they are into different types. I have some for long term. I know that this investment is short term. If I really need money, I can go for that one. And I've even made it a way that my savings are even investments. That's how I did mine. But it's very complex. For now, you just have to follow this until you have experience in it, and then you can definitely do it the way you want to do it. Someone, why is my investment? Why is my savings investment? I did that way because I realized that savings, if I'm putting it in maybe yellow save or bank account, I'll not be earning much. So I place it somewhere that I know I will be earning faster, and whenever I need money, I can go and withdraw that one. So that is for me. And so for now, you can focus on this one, and as you gain more experience, you can make it a bit complex. Okay. So you answer all these questions. Once you are done, there's a reflection session for you to answer that. Okay. So please, at the end of for the past month, no one has been sharing. I think only Judith Ohene. She's the only one who has been sharing uh, community prompts by the end of the week. Please, let's do our best to be sharing it. When we started this cohort, we were really doing it, but we stopped along the way. So please, let's do our best to continue. Okay. So I believe that by now you really understand risk, that it is uncertainty. It's not only about danger, but there's potential in it as well. Okay. And you also know that time smooth volatility and compounding rewards patience in investments. So for next week, we are going to talk about the different investment avenues. And that's where we are going to talk about the shares, we are going to talk about the fixed deposit, the T-bills, and all that. Okay, so you are going to understand fixed income versus growth in assets, and then why diversification exists. So Daniel, next week we are going to dive into diversification as well, and then how to match your investment goals to instruments. So if your investment goal is maybe to invest for school, then what kind of investment instrument or product should I go in for? So that is what we are going to focus on next week. So by the end of next week, you should have a mental map of your investing landscape. Thank you so much. And if there's any question on anything regarding tonight's session, please you can ask. If not, I hand over to Sebastian. Thank you once again.
Yeah, Ahmed, thank you. Guys, please, do you have any question before we end the session? If there's anything that you want to ask or any clarification that you need as well. Any? Okay, so I would end the meeting by saying we really need to understand everything that was discussed, because if you don't have the right understanding, the right information, you rush into things and later on you might be blaming people. Okay, so blame yourself if things happen like that. Now you need to do your best to also read more about everything or watch things related to this discussion, so that you understand a lot of the things for yourself as well. Okay, because investment that we want to do, we just want to grow our money, but nothing investment is what risk free. If you want to invest into your business or start a business, there is a high probability that you are going to make more returns. There's also a high probability that you wouldn't be able to finish it, or it will not go well and you losing everything. Okay, so it's the same way if you want to enter, let's say, the stock market or mutual funds and all of that. That's why we have what different risk levels, and you must know and understand um, your risk profile or your risk level, your investment horizon, so that once you start, you know if you're investing, you're focusing on long term or on the short term. Okay, so if there is no question, then I think we end it here and then see you next week for another session.